quite a while, but one of my New Year's resolutions was to make more video content for YouTube rather than just writing for Seeking Alpha, which is where almost most of my content is. The videos that I made back in 2021, when I first started up the YouTube channel, the first quarter there, have all done really well. I'll review those at some point here in the future as I make more videos. So I think, and usually my kind of outlook takes a couple years to develop. So now that we've had a couple years, you can kind of see how those worked out. And I'll kind of talk about that a little bit in this video, because the time frame that a person uses to analyze a stock or a business is really important. And this video is going to be about why investors should ignore analyst price targets. Okay, so whenever you watch CNBC or Bloomberg or maybe Fox Business, whatever place you're looking at, and they report a sell side analyst, usually the analyst predicts some metrics they think for the business, and then they use those metrics to give you a price target. And those price targets are almost always higher than the current price. And while I think the earnings estimates can be useful sometime, I would say most of the time, we're kind of in one of those times now where they might not be as useful, but they're at least useful as a baseline to work with. I use analyst average earnings estimates sometimes, quite a bit for some strategies, because I follow a lot of stocks and I'm not an expert in any particular business. And that's their job to work. Usually they work in just a certain area, a certain business. And in that aspect, they can be pretty useful when it comes to earnings. But they are not useful at all when it comes to price targets. So I am of the opinion that price targets should be completely ignored by investors. And here's why. So fundamental analysis, which is basically an analysis usually of earnings and earnings growth over a particular time period and how that will correlate to the stock price, works really well on average over long periods of time. So I'm going to link this in the just show notes or video notes. But this is from Jeremy Siegel wrote this in 2002, early 2002. It's a pretty good paper. I skimmed through a lot of it. I agree with most of it. But so this data goes to 2001. I'm going to look at a closer one that goes since this time here in a minute. But this is historical PE ratios going all the way back to 1871. And what he points out here is that the average was about 14.5. Usually I count that as like 15. Over this 100+ year time frame, okay? And this is for like the S&P 500 or equivalent proxy for other time periods, because I think the S&P started in the 60s. And what he points out here is that if you use the earnings yield, which you'll see me use on a lot of my full cycle analysis, let's see if I can find it here. So the average PE, here it is. So average PE ratio is 14.5 during this time period. That corresponds to an earnings yield of 6.9%. This earnings yield almost exactly equals the 6.8% real return, so that's in excess of inflation, that stockholders have earned over the same time period. Okay, and then he cites Schiller and Campbell for this, right? So this was a good predictor of 10-year real stock returns. And there's evidence through this time period that supports that. And at the end of this, Siegel gives a prediction from 2002, and he was pretty close to being on. He was a little more optimistic than the exact PE ratio at the time. The one thing I would add to this is it depends on how quickly earnings are growing relative to what the PE ratio is as well. So if I was going to do something like this, I would want to know how fast earnings were growing. That's the other factor that you don't really know. But when you take a giant long period of time like this, it all works out. So over 10-year periods of time, we know there's really strong evidence that an earnings yield or PE ratio can help predict real future earnings within some range. And when we look at the fast graph that I have up here, this is of the S&P 500 ETF SPY, so that way we can get earnings. Because sometimes it's hard to find the actual earnings of the S&P 500 stocks that are all aggregated. So the dark green area here is earnings per share, operating earnings per share, and the black line is the price. And if you just look at it over this 20-year time period, you basically see that price generally follows earnings, right? Even over somewhat short periods of time. Although if you look at let's say the P ratio is 18 in 2007. So that would correspond to like 6%, we'll say. Yeah, like a 5.5% earnings yield. And if you went forward to 2017, well, let's just do it. Over the short period of time, the first 2 years or 2 or 3 years, you would have had negative returns. So you would not have gotten 5.5%. So the PE ratio at the beginning of 2017 did not correspond to the stock price in the first several years here, right? But if you go out 10 years, and I actually don't know what this is going to show. So we'll go out to 2016, what I started. Yeah. So we want the end of 2016. Right? For 10 years? I think that's close. Just do it like that. So what I say, 5.5, and I wasn't even paying attention, and we had 5.9 is the real total return, okay? And during this time, we actually probably had just a tiny bit of inflation because this period was very deflationary. From 2007 to this 5-year period, and realistically was, especially if you were in the housing market or anything like that, was pretty deflationary. So we didn't really have that much inflation during this time period. So that looks about right. And I just randomly kind of chose that to make the point that even though it's predictive 10 years, it wasn't predictive 2 years, 3 years, 4 years, even 5 years. So we can just generally see that it works even recently, even though the valuations have gotten higher. The general correlation between earnings fall, stock prices fall, earnings rise, stock prices rise. You can generally see that is there, okay? So, but the trick is the time frame. The time frame is what's important. So these analysts are pretty good at predicting earnings because that's their job, although on some cyclical stocks they don't do so great. And I did much better than them when it came to Alphabet, which is maybe why I'm choosing it here. But what we can see is, let's go to what I want is, so this price is going to be split adjusted. If we look at it pre-split, it would be like 1740, like 20 times that. So just keep that in mind here. But what I want to show is they have an analyst scorecard on fast graphs. So in terms of predicting earnings, let me move my face out of the way. Predicting earnings 1 year forward, analysts were pretty good. I mean, more than almost 80%. 2 year forward, almost 90%. Okay? So analysts are predicting earnings 2 years out and 1 year out really well. Okay? But now, so that means they're pretty decent at, figuring out what earnings are going to be. So now let's look at their price targets. Keeping in mind the current price is about in between 1700 and 1800. Okay, so they were basically right on their earnings prediction short term. And let's look at some of just a sampling of, if we can keep the ads off here for 10 seconds. Sampling of the price targets. I told you the pre-split was like, if you, it would be in between $1,700 and $1,800 right now. So here's what analysts who got the earnings pretty right were, what their price targets were. From last year going into this year, these are all over 3,000. A lot of them are double what the actual price is. I mean, they missed the price target by double or 50. If you're going backwards, it's 50%. I mean, it's 50% lower than they predicted. Or you could say they were predicting the stock would be 100% higher 12 or 18 months or whatever in the future. Remember, these were made back here, and they were absolutely all wrong. So all the earnings were mostly right. Their stock predictions were off by magnitudes that would make people want to jump off a building if they actually listened to them and invested thinking these were the prices they were going to get. And it all has to do with the time frame that you're dealing with. Over short time frames, stocks can do anything. They really can. So a lot of times I'll write articles, and this happens so much. I'll list my buy price, which is the price that I would be willing to pay it for a stock, and Google's actually getting close to my buy price now. And people will say, your price target is ridiculous to me. I'm like, well, it's not a price target. I can't predict what the market will pay a year from now based on earnings and earnings growth. Now, if you have a giant drop in earnings or a giant boost in earnings, yeah, you usually know the price is probably going to correspond. But it doesn't, even then, it doesn't always. So when I give a buy price for something, I'm not saying this is where I expect the price to fall. What I'm really saying is, if you can buy it at this price, the odds of you getting good returns over the next 2 to 5 years are really good. You might have to wait 5 years because sometimes it takes time, especially if there's a recession or any kind of issues that happen along the way. Most of the time, 2 to 3 years, when I buy something, that's how long it takes to decide whether the thesis was good or not, and the price eventually follows the earnings. But sometimes it can take longer. So really what I'm saying is, over the next 5 years, there's a good chance that if you can get it at this price. Now, my buy prices are the prices at which you'll get good returns if you buy them, if you can get them. But they also do need to be realistic. Sometimes stocks don't always trade that low, but you don't need every stock to trade that low. You just need about 10 or 20% of the high quality stocks that you track. If you track hundreds of them like I do, you only need like 10% of them to get down to a buy price that's acceptable, and you can buy. And if now that you're getting paid 4% to sit on cash, there's absolutely no rush. You can just sit and wait for the prices at which you'll get good returns. I mean, it's really, really simple, but I really think the financial media just programs people. There's no evidence that these analysts' price targets are anywhere near reality, but for some reason people pay attention to them and think they are. I mean, there's no evidence that they are. I mean, you can just see, and I mean, this is just one stock I picked out as an example, but I mean, I could pick out dozens and dozens, and I mean, they're almost always wrong, especially in a downturn. So if you think about it, I mean, it's just a key thing that you really need to think about. There is an underlying business. There is a general price that the market's willing to pay, and sometimes they offer it up to you a little bit cheaper, and that's how you make money. Now, that's how we make better than average returns, by not doing what average investors do. So I think that's my basic thing. I'm not going to run on too long about it, other than just keep ignoring the price targets, pay attention to the earnings estimates. in when right at this transition period we're at right now, those earnings estimates can be wrong too. They were wrong with Google, and they're going to be wrong with some other ones, and that's what I've spent a lot of time writing about. But generally speaking, if you're in the middle of a cycle and not going into a bear market or recession, um, analysts do a pretty decent job of figuring out what earnings will be a year or two. You know, just don't listen to their price targets. All right, that's all for now, and I'll talk to everybody later. Hopefully, I'll be able to put some more videos out this year.